Okay, let's get right into it. On the surface, everything in the economy can feel pretty normal. Markets are doing their thing, people are getting paid. But deep down, in a part of the financial world most people never even hear about, something really fundamental has started to break. I mean, think about that for a second. It is a simple question, right? But it's got to be one of the scariest questions for anyone with savings or investments. What do you actually do when you're told that the money you thought was safe and accessible just isn't? Well, this week, that terrifying question stopped being a hypothetical. Some of the biggest, most respected names in finance, we're talking Blackstone, BlackRock, Morgan Stanley, are telling their investors that very thing. Sorry, you can't have your money back. It's locked up. So, to really understand why this is happening, we've got to look at the crazy, explosive growth of this thing called private credit. Believe me, this is not some tiny niche market anymore. It's an absolute behemoth that has totally changed the financial game. Let's just rewind the clock to 2015. Back then, the entire private credit industry was managing about $500 billion. A big number for sure, but really nothing compared to what was coming. Now, fast forward to today. That number hasn't just grown, it has absolutely exploded to $1.8 trillion. So why? What happened? Well, after years of super low interest rates, big investors were just starved for any kind of decent return. They were desperate, and private credit looked like the golden ticket. So what even is private credit? Honestly, it's simpler than it sounds. Just picture these massive pools of money that basically act like banks, but without all the strict rules and regulations. See, after the 2008 financial crisis, the big traditional banks had to pull way back on making riskier loans. Private credit funds saw this huge gap in the market and just jumped right in, lending money directly to all sorts of companies. But, and this is a huge but, there's a catch. At the very core of this whole $1.8 trillion industry, there's a huge structural problem. You could call it a fatal flaw that was baked into the model right from the very beginning. And this right here, this is the fatal flaw. On one hand, you have the promise they made to investors. Hey, don't worry, you can pull your cash out every 3 months. Super liquid, super easy. But on the other hand, you have the reality of where that money is. It's tied up in these long-term private loans to companies. You can't just flip these on a stock exchange. They are fundamentally illiquid. It's a complete mismatch, a ticking time bomb that only works as long as everybody doesn't ask for their money back at once. And that's exactly what's happening now. This isn't some abstract financial theory anymore. The bomb is going off. The dam has broken. And the fallout is starting to spill out of the shadow banking world and into the real economy. Just look at the data here. This is it. This is the proof. BlackRock gets withdrawal requests for over 9% of a fund's assets, and they could only pay out half before slamming the gate shut. Morgan Stanley capped payouts at just 5%. And Blue Owl? Get this. They've shut down redemptions permanently. They're just handing out IOUs. The rush for the exit is on, and they're locking the doors. And if that wasn't bad enough, there is a massive accelerant being poured on this fire: AI. JP Morgan is already blocking new loans to software companies. Why? Because AI is just completely destroying the business models of the exact kind of software as a service companies that these private credit funds loaned billions to. Think about it. A company that used to charge 50 grand for a service is now up against an AI that does it for $100 a month. The revenue just vanishes. And those loans, they're never getting paid back. So how does this Wall Street problem become a problem for, regular people? Well, here's the roadmap. It starts when these funds block withdrawals, which forces them to try and sell their assets at a loss. Then the banks who loaned money to the funds start taking losses. So what do the banks do? They get scared. They tighten up lending for everybody. Suddenly, normal businesses, your local construction company, a restaurant chain, can't get the loans they need. They can't refinance, they can't expand, they can't even make payroll. And what comes next? Job losses. That's how it travels from their balance sheet to your street. So what we have is this toxic mix: a liquidity mismatch, AI vaporizing asset values, and a clear path for the pain to spread into the real economy. But what is really going on underneath it all? Let's see what one of the smartest players in the game has to say about it. So these private credit funds are in a tough spot, right? They're desperately trying to sell off these loans to raise cash. They're putting them up for sale. And PIMCO, one of the biggest, most sophisticated bond investors on earth, takes a look at what they're selling and says, no thanks, they are not buying. That kind of silence from a player like PIMCO is a massive, flashing red warning sign to the entire market. And that brings us to the final, absolutely chilling diagnosis from a top executive at PIMCO. He said, and I quote, "You are not looking at a liquidity crisis, you're looking at the early recognition of a solvency crisis dressed up as a liquidity crisis." The difference here is absolutely critical. A liquidity crisis is a temporary cash flow problem, like you can't get to the ATM right now. A solvency crisis means the money's not even in the bank. It means the assets themselves are worthless. It's not that these funds can't sell their loans, it's that the loans might be worth nothing at all. Which leaves all of us with a really unsettling question. What else out there is just a crisis in a costume?